Hey everyone, and welcome to this explainer. Today, we are pulling back the curtain on a really fascinating player in the insurance space, Goosehead Insurance. We're going to put on our expert analyst hats and run a complete fundamental deep dive. We'll be breaking down their SEC filings and running their business model through the legendary investment lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, while also looking at how they stack up in a classic discounted cash flow valuation. Okay, let's just dive right into this. Before we get into the heavy number crunching, we need to establish exactly who Goosehead Insurance is. Founded in 2003 and taken public back in 2018, they're a rapidly growing, tech-enabled personal lines insurance agency. Basically, they've built their entire identity around modernizing a very old-school process, which is how you and I buy coverage. And here's the crucial part. They do not take on the actual insurance risk themselves. Instead, they operate strictly as a distributor, partnering with over 450 carriers to find the best policies for their clients. It's a very capital-light model, which is a perfect setup for generating the kind of consistently high returns on equity that Warren Buffett absolutely loves. But, it begs the question, how do you actually disrupt a market that is massive, heavily traditional, and notoriously slow to change? Well, to understand that, we have to look at the battlefield. And that brings us to this absolutely staggering number, $531 billion. That represents the total U.S. personal lines insurance market. It's a total behemoth, and for Goosehead, it represents a massive, massive runway for growth. Now, what's really interesting here is how that $531 billion is actually spread out. Despite the market's sheer size, it's incredibly fragmented. There is literally no single carrier out there that owns more than 20% of the market share. And where does Goosehead sit right now? They capture less than 1% of it. Honestly, if we apply Peter Lynch's investment framework here, this is practically a dream scenario. You've got a highly scalable company operating in a boring, highly fragmented industry with just a massive runway to expand. So, how are they actually making their money? The vast majority of their 2025 total written premium, which is just the total amount of gross premium placed with their partner carriers, comes from two main sources. Home insurance makes up a hefty 63%, and auto insurance comes in at 34%. The leftover 3% is just a mix of other lines, like flood, umbrella, and life insurance. Now, this heavy reliance on home insurance is a really core feature of their business, and we are definitely going to circle back to that later when we talk about the risks. But the real engine driving Goosehead's incredible growth is their distribution network. A whopping 82% of their premiums are driven by their franchise model. This is the secret sauce right here. It allows them to expand nationally at a rapid pace without taking on the heavy capital expenditures of opening up corporate storefronts everywhere. Now, you might be wondering about that remaining 18%. While the corporate agents who operate out of their beautiful headquarters in Westlake, Texas, make up the smaller slice of the pie, they serve a really vital strategic purpose. This corporate team basically acts as a crucial testing ground. It's an R&D lab where management develops, tests, and refines their proprietary tech and sales blueprints. Once they perfect a strategy there, they roll it out to the franchisees to maximize their productivity. And all of that centralized support leads to an incredible metric, an 85% client retention rate. If we pull out Warren Buffett's checklist again, this right here is a massive economic moat. High retention means high switching costs for consumers, which builds this beautiful compounding base of recurring revenue that long-term investors just drool over. Essentially, once Goosehead acquires a customer, they tend to keep them. All right, let's shift gears to the financials and see how this high retention and franchise expansion actually translates into cold, hard cash. You can see the momentum super clearly. Total written premium grew a really solid 17%, going from $3.8 billion in 2024 up to $4.4 billion in 2025. In Peter Lynch's world, this kind of consistent double-digit expansion puts Goosehead squarely in his fast grower category, largely driven by that tech-enabled productivity and incredibly sticky renewal business. And that momentum has carried right into this year. Looking at the most recent Q1 2026 data, total revenues hit just over $93 million, which is up 23% year over year. But notice how they separate their revenue streams. They highlight highly predictable core revenue, things like renewal commissions and franchise royalties, which hit roughly $79.5 million, up 15%. Then you have ancillary revenue, which is heavily made up of contingent commissions based on carrier performance and weather events. That piece jumped 141% to almost $12 million. Understanding this split is absolutely essential if you're building a discounted cash flow valuation model. Why? Because that highly predictable core revenue makes forecasting your future free cash flows way more reliable. And better yet, this top-line revenue growth is flowing beautifully down to the bottom line. The adjusted EBITDA margin expanded a full 6 percentage points, jumping to 26% in Q1 of 2026. This is classic operating leverage in action. As the business shifts more heavily toward those high-margin renewal revenues, profitability scales up way faster than their expenses do. Okay, but let's flip the coin. No fundamental analysis is complete without objectively looking at the risks and the macroeconomic headwinds. We really need to channel Benjamin Graham here. We have to assess the downside to figure out if there's a true margin of safety at current valuations. Internally, one major metric from the filings that you've got to keep an eagle eye on is the number of unvalidated producers. This is an industry term for new agents whose production doesn't quite cover their wages yet. Since Goosehead is constantly in hiring mode, these new agents require upfront investment, training, and, well, time before they actually flip to becoming profitable for the company. If agent productivity starts to slow down, this metric can quickly become a serious drag on earnings. Externally, the risks are heavily tied to the macro environment. Goosehead's 10K specifically warns that because 63% of their premium is in home insurance, they rely heavily on housing transactions. Spikes in interest rates that stall home sales will directly impact their ability to write new policies. From a Benjamin Graham perspective, looking at his defensive investor checklist, you really have to pause and ask, does the current stock price offer a margin of safety if we hit a prolonged housing freeze? Plus, this creates heavy seasonality in their earnings, and their exposure to variable rate debt means higher interest rates directly increase their debt service costs. So when we synthesize Wall Street's outlook on all of this data, we see a very, very clear divide. The bulls praise the tech platform, that sticky 85% retention rate, and the maturing franchise network as a massive moat for long-term profitability. The bears, on the other hand, strongly caution against a rich valuation that leaves practically no room for error. They warn that reliance on mortgage originations could cause some pretty unpredictable fluctuations if the housing market gets rocky. Yet despite those undeniable macro risks, the overall Wall Street consensus remains largely positive. A combined 59% of analysts currently rate the stock a buy or a strong buy. A solid third recommend holding, while only 8% have slapped a sell rating on it. And you can really see this optimism reflected in the average analyst price target of $74.67. That represents roughly a 44% upside from recent trading levels. When these analysts run their discounted cash flow models, they're clearly betting that the long-term compounding terminal value of that franchise engine is going to completely override any short-term housing fears. So ultimately, the question you have to ask yourself as an investor is this: does Goosehead's Buffett-like moat of 85% retention, combined with their Lynch-like rapid franchise growth, justify buying in right now? Or do the macro housing risks mean there is simply no Graham-style margin of safety at these premium valuations? It's a fascinating standoff for sure. Thanks so much for joining me on this explainer, and we will see you next time.